Good day, traders. What's going on? This is Prof from Benco Forex Academy speaking. I want to welcome you back to the channel. If this is your first time, make sure you subscribe to the channel by hitting that red subscribe button, and don't forget to turn your notifications on so that you don't miss any of our future content. On this channel, we talk about order blocks, we talk about price action principles, we talk about the nature theory of market structure, we talk about the Elliott wave principle, we talk about a lot of things, and you don't want to miss that. We also send analysis from time to time in our free groups, so make sure you also join those groups, those Telegram groups. I have included the links in the description below. So without wasting your time, let's get into business. Today I'm going to talk about a simple yet powerful strategy based on Fibonacci retracements and order blocks. So we're going to combine those two concepts to come up with this beautiful strategy that I've been using for quite some time. You just need to follow these instructions that I have laid down here. So what we would want to do is to identify our market structure. How are we going to identify market structure? We are going to look at order flow, and we're going to use trend lines. We are going to use trend lines to then see the points of market breaks, the point of market shifts, so that you clearly follow and understand. We want to keep this simple as possible. Remember, I promised you that this is going to be simple and powerful. After that, you then want to identify your point of reversal. And then from the point of reversal, you would want to identify your first impulse move. When we're talking of an impulse move, we're saying a move that is going to change the direction of the trend. This, you're going to see this by what? By break of market structure, by shift in trend, by what? Then after that, after you identify your first impulse move, you would want to identify swing points. So you would want, if you are in an uptrend, you would want to identify your swing high and your swing low. Then from the swing points, we would want you to anchor your Fibonacci on that swing point. So you're going to identify or to mark the highest point and the lowest point, including the wicks. Then in those highest and lowest point, what I would want you to do is to pull your Fibonacci to those two particular points. Then when you pull those your Fibonacci to those two particular points, I want you to identify your areas of interest that I have said, the point of interest. Your areas of interest are going to be 61.8 and 78.6 area. I'm going to explain more on that as we go into our charts. Then in those areas, what I want you to identify is your order blocks and your propulsion blocks, your mitigation blocks, and your breaker blocks in those regions. So make sure you identify those well. And then from there, we are also going to talk about screening order blocks to lower time frames from higher time frames, so that you reduce your risk. If you are trading a small account, obviously the problem that you might face is risking 1% when the amount itself is not even equivalent to what can I mean, maybe you have a $100 account and you're supposed to risk $10, or you have a $10 account and you're supposed to risk $1. In some assets, that can be very problematic, because the stop loss itself, if you count the textbook stop loss pips, they will then cover all your capital amount. So we would want to make sure that you reduce the risk trades, and we can do this by filtering our order blocks to the lower time frame possible, even up to 1 minute time frame. So let's just get into charts and explain these concepts, all of them, so that you can follow through and apply this in your charts and back test it in your charts and see how powerful and beautiful it is before you apply it to your real price action. So I have USD Swiss franc here, daily time frame, and what I've just done is I've just taken price action up to this point here. I've taken my price action up to this point here when price was just going in a downtrend. How do you identify this downtrend? You can watch my videos on support and resistance, where I explain trend So here a trend is simply a series. If you are going in a downtrend, is a series of what? Of these higher points that are lower. So it's a series of lower highs, lower highs, lower highs as you go down. Whereas you are given a lower high, you're also going to be given a what? A point of lower low, a lower low point. So as you are having these lower highs and lower low points, we are saying you have a what? You have a downtrend. So you would want to ride with the trend, isn't it? Remember, trend is your best friend. So you would want to ride with the trend. So what we would want to do is price is trending like this. At a point where price is going to reverse to the opposite side, at a point where price is going to reverse, in this case, going into an uptrend, that's where now we are saying wait for price to give you the first impulse that is going to do what? That is going to break structure. Let's just put those concepts across. That is going to break structure. So this is your market structure. Breakpoint is the previous swing point, or this previous higher low point. So if market is going to break these previous higher low points, we would expect that market to start creating what? Higher lows as it go to the upside, and higher highs as we go into an uptrend. So what we are simply waiting for is what? Is for a break in market structure. When you look at this price as it is going down, we are saying the market structure is bearish in this case. So the market is going in a downtrend. The market structure is bearish. When we talk of reversal and change in the market structure and the break of market structure, we are talking of a situation where price is now changing from this downtrend going into an uptrend. That will be a change in market structure. So what we are simply waiting for here for this strategy in particular is a change in market structure, is a break in market structure. And in this case, we would want to use trend lines. I know that using other strategies that are explained on this platform, only a break above this point here will be a break in market structure, especially if we then combine that break with the this area that you are then given there, which can be a possible resistance area for price. But for this particular strategy, these confluences are not important. We'll talk about them in another video. We just want to stick to our trend lines and the market structure itself. So as the price is going to give you the first impulse here, what I want you to do is I want you to then identify swing points, a swing high and a swing low in this case. So what I'm going to call swing points is this beginning. If this is going to be the point where price is going to get power or energy or momentum to go to the upside and break this trend line, which was acting as what is also a resistance line, we are saying you identify this point as your swing low. And then the point where market is going to reasonably start retracing deeply in, coming back in a counter trend direction, we are saying that point will then become your swing high. So what I would want you to do using this strategy is I would want you to then anchor your Fibonacci or pull your Fibonacci from this point to that point, which would be the swing high point. Then after you do that, step number 2 is I would want you to identify areas of possible continuation of trend on this first impulse move. Let me just play price action so that we can get that price back there quickly before we can identify our point of interest. You see price is breaking the trend line first, which is acting as the resistance, is coming back to retest the trend line there. Then after retest of the trend line, let me just pause it a bit and explain something there. So just earlier on I had a resistance line indicated there, and this point indicated as what is the higher point of market structure break. Is this price impulsively breaks, it is a broken market structure. If you go and watch my order blocks video, I talk about this entry point as break of market structure, then a retest of the order block that led to break of market structure. in that particular situation, you'll be trading what? You'll be taking your trade from this point. All right, but this is at the beginning of the trend. This is your first entry. What we want is a retracement entry on the first impulse that will be given, which is going to give us a big trade, a swing trade, as you will see. Let's just continue doing that. Let's play price and see what we're going to have there. All right, I'll pause my price action right there. All right, so after these three stretches to the upside, this 1, 2, 3 stretches to the upside, let me just remove the arrow and keep my charts clean. After that first impulse move, what you're going to have to do is you're going to have to pull the Fibonacci from this point up to this point here. So this lower point where I've anchored my Fibonacci there is going to be my swing low point, and this up point is going to be my swing high point. So what I want to do with this first impulse is I want to find point of interest. I want to find a point where I can reasonably join this trend, because this retracement is a possible retracement to then get energy to continue the trend. So what I want to do is I want to make sure that I join the trend, because the trend is my best friend. Remember, this entry here was a bit risky. Why? Because the trend had not yet been confirmed that we have changed the trend. Yes, it's a break in market structure, but this previous point of the trend had not been broken. But if you check now, the situation that we have on the chart is that this point has been what? Has been broken, and it has been confirmed that trend is most likely now going to the upside. So what I want you to do is I want you to then identify point of interest on this first swing point. So the point of interest that we are going to be using today are our order blocks. So I want you to identify order blocks on the first impulse, order blocks that you will use to join the trade. So the question is, which order blocks are we going to use on this movement? Which order blocks are we going to use? So what I want you to do is I want you to focus on the region of 61.8 and the region of 78.6 retracements. Let me just explain that a little bit. Let me use my ray line there. So if I go on to my chart and separate this swing point into two, using the 50% level mark there, I'm simply saying that when you look at this market above 50%, this market will be in a premium. When you look at it below 50%, this market will be in a discount. So if we are looking to buy this market going to the upside, we would want to buy in a position where we are at a discount position. At 50% exactly, we are simply saying the price there is in equilibrium. So it's balanced price there. But what we would want to do is we want to buy the dip. So we want to buy in a discount. We are going to come down here and look for positions that are, or order blocks rather, that are at 61.8 and 78.6. When I'm using the word order blocks, remember that I'm also including the propulsion blocks at these points. I'm also including the breaker blocks on these points. I'm also including the mitigation blocks on these points that I'm discussing about. So if you don't know anything about the breaker blocks or the mitigation blocks or the propulsion blocks or order blocks in simplicity, just go to my videos on these channels under order blocks. I created a playlist on order blocks. Just go and watch those videos. They will help you understand what we are talking about. If you still don't understand them, you can join one of my free Telegram channels or my WhatsApp group. Then you contact me through those channels. We can have a proper discussion on how we trade these order blocks and how best you can make use of them. So let's continue with our exercise. So what we want to do is we want to identify those order blocks that are located either around the 61.8 area, around the 61.8 area. So if you check the 61.8 area, there is this one above the 61.8 area. There is that above the 61.8 area. Then you also identify order blocks where at the 78.6 order blocks area. Let's just play our price action there. Then you see what happens as we go, as we get to that point. So I can safely take the body of this candle, or rather this candle, to be my order block, because all these other candles are within this order block. Then when I mark that as my order block, so I have two order blocks here. I have a propulsion block which is above, but I don't necessarily expect this to be a strong order block that will hold. Why? Because it's not exactly at my area of interest. If I'm going to take order blocks that are above my area of interest too much, if the body was sitting on 61.8, if this body was extending to this point, then I would consider that to be a strong order block, because it's exactly sitting on 61.8 retracement. But this body closed far away from the point of interest. If so, because it closed far away, it will be a low probability order block. You can test this through your charts and see what I'm talking about there. Then I would have taken this again as my propulsion block, but I didn't, because it didn't trade directly into the body of this particular candle that we are talking about. Remember, the body is where most of the volumes are. So I'm going to take this as my order block. If I take that as my order block, as price comes to this order block, what I will simply do is I either take the entry as the price trades into the high of this order block. I will be taking my entries up until the mean threshold of this order block. So I will take my entries between the high and the mean threshold of my order block. But as price leaves this high of this order block, you should not take any entry. As the price leaves there, you should not take entry. Why? Because the price would have left your area of interest already. So if I'm going to take my entries between the 50% mean threshold up to the high of this candle, where do I put my stop loss? I will put my stop loss below the close of this order block. So below the wick of that particular order block is where I will then put my stop loss. Now, if you are afraid of taking these trades as the price trades into this order block before you even have confirmation that the price is going to move to the upside, what you can simply do is you can set an order there which is going to be triggered even when you're not on the charts. Then you set your stop loss below there. You should not be afraid to lose if you have to use this strategy. Why? Because every trade you enter into, whatever strategy you're using, every trade you enter into is a loser. Every trade you enter into is a loser. You have to work your way out of that losing position, and this is the best way to do it. And if you are afraid of taking trades, you never make money in the market. So this is how you then take that particular trade. Let's just play price action there and see what happened here. So as price pushing to the upside there, as price pushes to the upside there, what you're going to see is as price was also coming down, let's just use our trend line there. As the price was also coming down, it was making a series of what? It was in a downtrend. It was making a series of lower highs. It was also in a downtrend. So that was market structure which was bearish. That was bearish market structure. So what happened? What happened is we had this up move that broke market structure to the upside. So what do you do again? You also do the same thing that we just did in the previous example. What you're waiting for is for your swing points. Like there, we now have our swing point there. So what I'm going to do is I'm going to take my Fibonacci, then pull it from this swing low to the swing high. After after I pull it to the swing low up to the swing high, what do? I will then go and mark my 78 level and again my 61.8 level there. Let's just adjust this Fibonacci. Let's adjust it so that it's on top of the wicks, exactly on top of the wicks. There it is. All right. Then if you check here, before price had this momentum movement, it created this double bottom there. It created this double bottom. It failed to break the previous low. It created this double bottom. Then from the double bottom there, what do we have? What do you know about this? About this W here? We have this W there. Before that up movement, this is our mitigation block. It didn't break the previous high there to be a breaker block, but this point is our point of mitigation. What is going to happen is people who sold going to the downside, as the price comes back, they might still be holding this position, some of them with no stop loss. And when price goes against them like this, if they're still holding these sales that they sold to this side, as the price is coming back, what these guys are looking to do is they are looking to mitigate the orders that they had taken to the low, to the sell side. They are looking to release these orders possibly at break even from this particular point. So that release of the orders that they have will force price to then go back to the upside. That's a mitigation block. If you want to know how to trade it, then you also need to go and watch that video that I just mentioned on this, which is on this channel again. So as the price comes back into this mitigation block, which is again located at what? At the 78.6 level, you then look to what? To take your trade. But here is the trick. Here is the trick. Trading a mitigation block and a breaker block is different from trading what? From trading a straight order block. Let me just explain the difference here. When you are trading a mitigation block, that is different from when you are trading a what? A straight order block. So as the price comes here to retest this mitigation area, what you would want to do is you go to your lower time frames here. You go to your lower time frames here. Then when you go to your lower time frames, what you will do then is you then wait for if you go to M5, then you wait for the first impulse from this area of point of interest. You wait for the first impulse on that M5. Then after the first impulse, you then would want to make sure that the first impulse is broken structure on M5. That first impulse should break structure on M5. Then after the first impulse breaks structure on M5, you then look to take the trade. If then the price retraces back to the order block that led to the break of structure in M5. So you are going to go to either M5, since we are on daily time frame, you can go to M5, you can go to M15. Then on that particular time frame, you then wait for the first impulse on the lower time frame. Then after the first impulse, you then wait for price to come back to retest the order block that has led to that first impulse, or that has given momentum to the first impulse. That order block of an order block is what you then look to trade, if it's a mitigation block or it's a breaker block like what we have here. So let's just play our price and see what happened. So that's the reaction that you would want to see from an order block. You would want to see that momentum going to the upside. So what can be your possible take profits here? For take profits, we are going to use the same rules that we use when we are trading order blocks. So you are going to use what? Just the immediate swing high. In this point case, you will be looking to what? To just take your profit from this point here, or you then take partial profits as you get to this point. point here. Also, from this trade that we just took here, you would want to take partial profits from this point here, from this point, from that point, going to the upside, targeting your maximum take profit to be this highest high point that you're given there. So here I have US 30, I have the Dow here. What I'm going to do is I'm going to, if you check here, price has been making a series of high highs, and there is this correction which is a broken structure here. So I'm going to start my analysis from there so that we move together and you understand these concepts, and you get to apply them in your charts as well, as much as I'm applying them here. So as the price was going to the upside, there was a break in market structure here. Let's just mark everything so that you can follow through. There was a break in market structure here. From this break in market structure, what happened? Let's grab our trend line there. Price was making a series of lower highs there as we were in a downtrend. And what we would have expected is for price to then come and respect this trend line so that it maintains the downtrend as we go to the downside. But what happened is price came with high momentum, and then it traded through the trend line, which was supposed to be our resistance area. So now let's wait for the first impulse to complete. The first impulse is just completed at this point, and from the beginning to the end of that particular impulse is where we are going to anchor our Fibonacci as the lowest high point and the highest high point. Note that as I'm pulling my fib here, as I'm pulling my fib here from the highest point to the lowest point, as I'm pulling my Fibonacci, I'm starting from the point where the movement started up to the point where the movement ended. So what I'm going to do is, after doing that, I'm going to identify my areas of interest. I have this 61.8 area there, and I have this 78.6 area there. So what do I do after doing that? What I do is I then identify my order blocks. I will then mark my order blocks in that particular area there. All right, let me just remove the fib there. So the particular order blocks that I do have is this order block here. So I'm going to just shift this line to the open of this order block. So I expect the price to react between this highest point up to the midpoint of that particular order block, if this order block is to hold. And this order block should be respected. It should be respected in such a way that price should not close of any candlestick that trades into this, price should not close below the mean threshold. That's the rule that we're going to be using there. Then the order block at 78.6 level is this order block and this order block. So if the same situation that we had in the first one, if you check the body of this order block is containing the body of all these order blocks, including this one. So I'm going to take this as my order block. So if I take this as my order block, that's the order block that I'm going to have there. There it is. All right. Then as the price trades into this order block, as the price is going to be trading into this order block, what I would want to do is I would want to take my trade in between the high of this point up with the mean threshold. This price should not trade through the order block. Then I'll put my stop loss just below the wick of this order block. So my stop loss is going to be just below the wick of that order block. As the price trades through there, I take my entry, then boom, my take profit is going to be just above the opposing highs. So one take profit will be there, take profit there, take profit there, and finally take profit above the highest high there. I will be taking my partials as I go in the opposite direction there. So this is how you would look to take trades. But there is something tricky here about what we have just discussed. let's just talk about something here. If you are going to check the body of this candle, this is a daily candle. Okay, this is a daily candle, and if we are going to consider the open of this daily candle, price can trade through this daily candle the whole day. Only in the last 4 hours will the price reverse and then close above. So during all that day, are you going to be in a deep loss? Are you going to be in a deep loss? What are you going to do about candles that have a big body like this? Well, when you are looking at a candle with a big body like this, this is where we are going to this is where we are now going to talk about how we can screen the body of this particular candle. How can you screen this particular candle from a higher time frame perspective up to lower time frames, where you then have to take your trades, where you then have to reduce the risk that will be involved with you just taking this trade based on the open of this order block and waiting for them to hit your stop loss at the bottom there. So we talk about screening these order blocks just in a moment as we go to that particular area. Let's just look at the last two examples also, and the examples are going to be from volatility indices. I'm going to look at examples from volatility indices. Let me just switch charts. If you don't have a volatility index account, I have just included the link in the description below. Just follow that link and open a volatility index account. You just open it as a demo. Then when you are inside the demo, you then open a real account from there. So let's just look at the price action here from the higher time frame. Let me use the H4 here. From the higher time frame there, I'm looking at volatility 100 index. From higher time frame, I'm looking at H4. So price has been trending to the downside on H4. Price has been in a downtrend. From the H4 there, you can clearly see that the price is going down on H4 there. So what happened? We're expecting this point here to hold. We're expecting this point there to hold the price to continue going to the downside, because it has been making a series of higher lows. Price has been going down, so we expected price to continue going to the downside. But what happened? What happened is price then traded through this trend line, which was acting as a resistance. Then we were given this first impulse. So after we're given the impulse, what we are going to do is we are going to identify our swing points. This is going to be the swing low. This is going to be the swing high. Then after we mark our swing low and swing high, what are we going to do? We are going to identify order blocks that are located where? At 61.8 retracement, and at what? At 78.6 retracement. You can see this one is sitting right at the 78.6 retracement, so we can consider it. The situation is now different from the previous one, where it had closed far away from this 61.8. Now it's sitting directly on 78.6. These are going to be our point of interest. So as the price is going to trade into these order blocks, we look to take the trade in between what? From the open, from the high of this candle up to the mean threshold of the candle. We can even go to lower time frame to H1 to refine those order blocks. We can go to H1 to refine those order blocks. Let's just do this. Let's pull the fib again from the low to the high. So there we have our feed from the low to the high. Right, and as the price trades into this area that we have marked there, what do you see? We have this order block there, and this order block there, and above these two order blocks before the point of market shift, because this again there was a point of market shift there. Let's just identify it. so that you can clearly see what we are talking about. Price was making a series of what high lows, then there was that point of change in direction. When this blue candle was violated, there was a change in direction, and there was this propulsion block which came back to retest what? To retest that market point area, which came to retest that market point of break area there. If you look at that propulsion block, then you extend your line to the other side, you can see that as the price trades into this order block there, as it trades right into that order block there, into the order block open. Let me just indicate it on H1 so that we can clearly see what we are talking about. All right. So if I go back to H4, as price is trading into the open of that order block there, which is also on H1, that propulsion block there, we can look to take our trades there. Where do we put our stop loss? We will then put our stop loss below the order block that we have used to take that trade. Then where is our take profit opposing swing points? So the first one will be there, the second one there, the third one there, up until we get to the maximum point that we have there, which is can be a possible double top there. So that's what we have there on volatility 100. Let's check V75 if we can have one thing like that. Well, here I see that the market has been let me just use my trend line there. The market has been trending to the downside again here, isn't it? The market has been trending to the downside, and what happened? This point was broken there, the point of market structure break there. Okay, from the point of market structure break, what do we have? We have a swing low and a swing high. Let's identify those swing low and swing high. Then after the swing low and swing high point, what do? We then identify order blocks that are sitting where? Right at 68.1 and where? At 78. In this case at 78, there's only an area of support, which is this swing point which was violated. Today we are not talking about areas of support. We are only using order blocks. So there is this order block there that has been what? That we have identified, located at 61.8. Look at the body of this candle again. The body of this candle is too big. So if the body of the candle is too big like this, then you take your entry at the top there. Half the time, if price is going to trade through this, if you have a small account, that small account would have been affected harshly. So what we would want to do is, you would want to concentrate on what? On the mean threshold of this order block up to the high. Then we screen the order blocks to the lower time frames using that strategy that we are just about to talk about. So without wasting the time, let's go to volatility 25. Then we go on daily time frame. We are going to use this order block right here to do the screening process. So now we are screening our order blocks. We are going to use this to do the screening process. So for the screening process, if the order block is too huge like this, if it's too big like this, what you will do is you take your Fibonacci, then you just measure the body size from the wick to the wick of this candle, like what I'm doing right now here. Then after you have just like that, after you have this Fibonacci on, what you're gonna on the body, what you're gonna do is you're gonna identify the 50% level of this order block, as the price has not yet retraced to that level. After you identify the 50% level of that particular order block, I'm going to mark this as the high because I want to go to lower time frames with you guys. So this is the highest point. Let's put it as blue. Then this is going to be the lowest point of this order block. Then the red point is the midpoint, which is the mean threshold of the order block. This is the lowest point. This is the highest point. So what I'm going to do is I'm going to go to H4 on that particular area. On that particular area, I'm going to go to H4. Let's since we want the point below, let's just shade this area here, put a rectangle there. Right, so we have it marked. I'm gonna go to H4. Then from H4, the area that we are looking at is this area here. So this is not important anymore. I'm going to be focusing on this area here that we have here. So this is the mean threshold. This is the lowest point on the order block. So what we want to do is we want to focus on order blocks that are within this region only. If price is going to trade through the mean threshold, already there is a higher probability that the order block will not hold, because remember, we would want to make sure that the order block is not traded through the mean threshold. If price goes through the mean threshold, at least it should close. If in this case it trades through the mean threshold, it should close above or below rather this red point. We would want to see price closing in this region rather than this region. If prices start closing in this region, in most cases I'll close the trade even if it's in a loss, because I will be now saving my amount from this point to that point. Let's just go to H1 again and continue to screen the order blocks with the lower time frames using that strategy. So what I'm seeing is on the mean threshold directly, there is this particular order block there which I've been given there. Let me just change the color to black there so that it's visible as we remove these other things. So there is the mean threshold, this point here that has been that we can see there, that is sitting directly on the mean threshold. So I'm saying my order blocks here that I have is either this order block here, this order block here. I will take this as one order block because the wick is covering the body of this one, so all these are within this. So this is one big order block and this one. Let me continue to screen my price. They go to M15. On M15, so I'm looking at this shaded area. So on the shaded area on the far extreme end area there, I have this as my order blocks. So I'm considering this to be my order block here. Then this to be my order block there. Then this to be my order block again. So let me go finally on M5 and screen those order blocks and see how I'm going to be taking trades. So within this area, the shaded area, any entry is okay. Within this shaded area, any entry is okay. But what I'm looking for is I want to make sure that I minimize or I have my entries with as low risk as I can be able to take. So this point of interest here becomes my order block. This one is my first order block. But if I am going to do this, sometimes I'm going to miss entries. That's one of the disadvantages of this. If I'm going to screen to lower time frames like this, sometimes I'll miss entries, especially if I'm screening from a higher time frame like the daily time frame coming to this lower time frame. So this can be my order block. This one, let me check. This looks like it has been used already. So this order block has been used already. So I don't care about this order block here. Why? Because it has been utilized. On lower time frames, I just want those order blocks that has not yet been utilized. So this order block here has not been it has been utilized here, isn't it? It has been utilized. This order block has not been utilized. However, let's check if there's a fair value gap there. Yes, there's a tiny little fair value gap there. Then we also have this order block here. Which we can view because the wick of the second candle is covering the body, so we can take it from this point here. There's our order block. Then another one here. So because this order block here has been utilized here, I will not consider this order block. Rather, I will consider this order block and this order block.